There seems to be no stopping the surge in US yields. Interestingly, in comparison to that, the Indian bond market is showing remarkable resilience. What's lending it that strength? I have with me Abhishek Bisen, the head of fixed income with Kotak Mahindra Asset Management Company Limited. Hi Abhishek, and let me get in your comment first on the rise in US yields. Crossing 4.5% on last count. What is lending it that uptick? Do you think that the markets are pricing in perhaps a higher terminal yield or terminal rate from the Fed?
So yes, as far as the expectation and reality is concerned, that the game is on. The data, as far as the inflation data is concerned, that surprised the markets slightly on the upside. So which upsetted the markets, and typically market reaction, trading community started believing that the rate cuts getting pushed, and the market positioning was slightly adverse, which led to spike in the bond yields. But if you observe, we are trading at this point in time at 465 around. But with the incremental data being negative, there is a spike, but it comes back to around 465. So when such kind of phenomena starts playing out, it is said that it is already priced in. And having said that, we believe that it has pushed the rate cutting cycle by a couple of months. But in terms of overall quantum, we believe story is intact, and the terminal rate is definitely not gone higher.
Okay.
So that's how we read that.
I wanted to also get in your comment on the liquidity situation currently, because I think in April we seem to be in a bit of a surplus. So just getting in a sense of how liquidity is shaping up right now.
So liquidity situation is a fairly complicated subject because a lot of factors play into that. There are two components, something called core liquidity, then optical liquidity. So what you look at is optical, while central bank looks at the core, and the core gets impacted by FX and the currency in circulation. Also, there are many factors which are impacting the liquidity. But if you look at the cost of money, which has softened from the peak of 685 to around 670. And as in when we go in the next month, we again believe that it is going to remain here and slowly decelerate downwards. So that's how we should look at it, because otherwise it's going to be in a complicated game, and there are too many factors which are going to impact the liquidity. But the central bank is managing it very actively, and they will ensure that the cost of liquidity doesn't go higher than the previous highs.
And finally, what's your advice to investors who want to participate in the debt market?
So we have been saying for some time now that on purely fundamental basis, bond yields, we are at the peak of the rate hike cycle, and it's been some time. We've started thinking about cuts now. So from given that outlook, we have advised investors to increase duration as much as they can, because we believe that going forward, either we are going to have sideways move, and then as and when the cut starts getting delivered, yields are going to move downwards from the current levels. So it's a good opportunity for short-term allocation as well, and the trading community or asset allocation. So the way you want to look at it for both communities is good amount of opportunity or upside available from the current levels.
Okay, thank you, Abhishek, for that. That's the word of advice coming in for all debt mutual fund investors. Thank you for watching. Stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.